Income tax. First introduced in the UK over 200 years ago, in 1799, to help finance the Napoleonic Wars. Without it, Napoleon would have ended up in charge and we'd now all be speaking French. It was abolished in 1816, a year after the Battle of Waterloo. It was reintroduced in 1842 during the Parliament of Robert Peel. There were plans to abolish it again, but the onset of the Crimean War put paid to that. Even old age pensioners are liable to pay tax. HMRC have seen many types of tax evasion and avoidance methods. They don't want anyone to pay more tax than is required. So as long as the public are honest and straightforward with them, they'll reciprocate. Benjamin Franklin, even all those years ago, was right. So, let me introduce myself. My name is Peter Le Queux and I've had a long career in financial services both here and abroad. As you can see, I'm now self-employed. I was employed all the way through all of that. I now run my own business offering accountancy services mainly to small businesses and the self-employed. You get on, you've decided what you want to do, you're going to be good at it, you go and do that, but there are things that you won't be able to do possibly or need help with, such as tax. I'm not regulated by the FCA, so I cannot give financial advice. I can't advise you where to put your money. I can give you advice on how your tax return should be completed, but not actual financial advice as such. Right, you're ready to start up your own business, but now you need to know about taxes. You need to register with Her Majesty's Revenue and Customs. The easiest way is to call that helpline, explain to them what you want to do, why you think you should be classified as self-employed, and hopefully if they're happy and agree with you, they'll take you through the processes that they require you to complete. You don't have to do it on the first day of your self-employment, but if you leave it for more than 3 months, you'll get a little letter from HMRC saying you owe us £100. And the longer you leave it, they'll stick another £100 on it. So it's always best to get these things done at the beginning. Even if you don't start work today, register today. That you will be becoming self-employed. The sort of information they'll need is national insurance number, date of birth, that sort of thing, proof of address, etc. They should also ask if you expect your profits, that is your net income, for the first year of trading to exceed £5,885. I'll explain that figure a bit later on. After you've registered, they'll send you a unique tax reference number of 10 digits. This is basically your self-employed ID number, so now you've got a national insurance number, which you've got anyway. Now you've got what's called a UTR, so they can find you wherever you go. Self-employment, the national insurance, this is where the £5,885 comes in. People that are employed pay one lot of national insurance called Class A or Class 1. Self-employed people pay 2 classes of national insurance. You don't pay the Class 1, which employed people pay, but you pay Class 2 if your profits are more than £5,885, you'll pay £2.75 a week regardless of your maximum profits. So you could earn £150,000, you'll still only pay £2.75 every single week. But in Class 4, which is the other self-employed national insurance contribution, as you can see there, up to £7,956, you don't pay any Class 4 contributions. Any profits between £7,956 and £41,865, you'll pay 9% of that figure as an extra, as national insurance. National insurance is basically tax. So when you work, yep, sorry.
Class to go into, like, do you get put in a class or?
No, the way that, well, if you're self-employed, yeah, you will pay Class 2 and Class 4. Oh, right. If you're employed, you'll only pay Class 1. And as I say, for Class 2, as soon as you tell them I'm going to be self-employed, they will charge you then £2.75 a week, as long as you're earning more than £5,885 a year. You can get a dispensation if you think in the first year you're not going to earn that sort of money, and then they won't charge you the £2.75 a week. I mean, let's face it, it's not a huge amount of money. I mean, it's not even a pint now anymore.
What if you don't know whether you're going to earn that or not?
Then you tell them you're not going to earn it, because you can always go back to them and say, actually, I've gone over that limit now, so I'll need to pay it. But the thing is, if you tell them, I'm going to earn that sort of money, and you start paying it, but you don't get to that figure, it's almost impossible, I would say, to get that money back. So it's always better to err on the side of caution from your point of view.
Sorry to keep on questions. So what if you're self-employed, but you still have like a regular bar job where you're employed by someone?
Then you'll still be employed. You'll earn X from them. They will tax you and deduct national insurance according to how much they're paying you.
Yeah.
But then with the self-employed side of it, you will still have to pay the £2.75, and at the end of the year, the class 4 will also get calculated, but only on your self-employed income.
Yeah.
The employed income is, you're just employed, in effect.
Okay.
Yeah. Somebody else have a question there?
If any money you earn from an employed job won't affect your self-employed status as such?
No. No.
They must know, so if I've been working for a company and I'm employed, do they automatically know I'm employed? Because I think I told them it was self-employed money.
If you're employed, you should get a pay slip from your employer,
Yeah, I do.
and on there will be a tax code. And if you get paid, say, for example, £100, you'll see that they'll probably be deducting £20 from you, basic rate of tax, 20%. And they'll deduct a little bit of national insurance as well. So they pay you £100, but you only take home maybe £78, something like that. But that bit that's employment. And at the end of the tax year, your employer will send the HMRC a report to say how much they have paid you, how much they have deducted in tax and national insurance. So whatever your self-employment income is, you have to tell the revenue what that is.
Okay, so I don't have to keep my pay slip adding up and do that.
No, because at the end of the year, well, you say, for example, you get paid monthly, you'll get 12 pay slips in a year. At the end of the year, your employer will then give you a big piece of A4 paper that says P60 on the top. And that is a report that they have also sent to HMRC, but they're giving it to you so you have a copy. And you will declare that when you do your self-assessment tax return as self-employed. Because in that system of self-employment, in the online return, it says, have you had any income from an employer? Did you have employed income? And you tick that box and says yes, and it then asks you later on how much you had. I mean, it's all on the website, which we'll see sort of later on. But you will still do your own self-assessment tax return, but some of that will be employed income. And then it says on there how much tax did your employer deduct, because then that will offset against the tax that you've earned on your profits of your self-employed side of it. It's very simple, really. I mean, it's like falling off a log. But so anyway, so as I say, with the class 4, if you're earning more than 41,000 a year, not only will you pay more income tax, but you will also pay more national insurance contributions. So basically, as somebody said the other day, why don't they just change the name of national insurance and call it tax? It is a tax on income, because the more you earn, the more national insurance you'll pay. I mean, basically a ballpark figure is that if you wanted to work out how much money you were going to make, you know what your income is, just take 30% off. So if you earned £100,000, you know that after tax you'll take home 70, roughly. That's just a ballpark figure to play with. Good old VAT. So should your turnover, that's not your profit, it's your turnover. If you're invoicing people, you're sending invoices out for works you've done, and that will exceed £79,000, you must register for VAT. And if you register for VAT, here's the good news, that's more paperwork for you. That's more records you've got to keep. You have to report to the VAT man every 3 months, all the VAT. I mean, I can sit here and talk for an hour and a half on VAT, but I don't think we want to go there. Not yet, because it would probably take some time to get to 79,000, unless some of you are reaching for the stars, obviously. There's the website, how to register, and the VAT helpline number. You don't need to register for VAT if you're under 79,000.
So say if you exceed 79,000 and you do the whole VAT thing, you know, when you buy something and it says with VAT and without, can you only go for the without VAT once you've gone past that mark, or is it any time?
If you went out and bought something for £100, well, you always use £100. It's a nice, because it's a nice, easy figure to work with. You go out and buy something for £100, it actually costs you in cash 120, yeah? Because VAT rate is 20%. So the item is actually £100, but the VAT on the bottom is £20, so you paid 120. You go back and you do your VAT return, and say nothing else has happened in your business. You put your VAT return in and say that you've bought goods to the value of £100, and you're reclaiming £20 VAT. And then the VAT man sends you the £20 back.
Yeah. Is that only once you've gone past 79,000? Is that whenever?
It's once you've registered for VAT.
Okay.
If your turnover was going to be 30,000, you don't need to register for VAT. But if you went out and bought that piece of kit for £100, you're actually going to physically pay £120, but you can't claim that £20 VAT back.
Right.
So it's cost you 120.
Yeah.
But when you send an invoice out to somebody that you've done some work for, if you were VAT registered and you were going to send them an invoice for £200, because obviously you want to make a profit between buying that at 100 and selling it for 200, you would invoice them for £200 plus £40 VAT. But that £40 less the £20 that you've paid out for that piece of kit, you then have to give the VAT man £20. Right. So the 40's come in, you've paid the 20 out, and you give the other 20 to the tax man. Basically, you're collecting tax on behalf of HMRC. Okay. And you've got to do all the paperwork for that and get it in every 3 months.
Yeah. And does that process differ once you're turning over £79,000, or is it all the same throughout?
If you're not registered for VAT, then we don't need to talk about VAT. And you'll see that later. You see that later on. I've got a couple of invoices on here to show you roughly what's happening. For example, I'm not VAT registered, and I have no wish to become VAT registered. I'm not going to get anywhere near that sort of figure. But as I say, I could register for VAT tomorrow if I wanted to. But why should I when I'm not aiming to hit 79,000? I'm just giving myself more paperwork if I register for VAT.
Whereas the thing you were saying before, rather than registering for VAT, you could just charge your clients that extra money, and you're basically so you're working with VAT without actually registering for it.
In a way.
In a way,
yeah. As long as you don't tell people you're working with VAT because you're not VAT registered.
Right. Okay.
Yeah. I mean, as I say, the VAT is a whole other ball game. We can talk about this. You know, book me for the whole of next week, and I'll bore you to death on that one. Question?
So this is your turnover.
Yeah.
Which is all your money coming in, not profit.
Yes. So if you worked every week for various people, and you sent out invoices for £2,000 a week, that'll be about £100,000 a year. You must register for VAT. No two ways about it. But if you're working for sending invoices out for £1,000 a week, so that's £52,000 a year, well, less holidays, of course. You don't need to register for VAT. And at this point, it's probably better if you don't. You know, why do it unless you have to? You know, there's no law. The law says that if you hit 79, you have to register for VAT.
Hit 79
As your total revenue, turnover, sales, yeah, that's all the same thing. And it's not your profit that they're talking about there. But then if you're making £79,000 profit, you'd probably be a limited international company with, X number of staff and all that. And so you'd have somebody doing your VAT for you. So it wouldn't matter. But if you're going to just become self-employed or a sole ownership limited company, it all depends on that 79. But when you're starting up your own business, do you really want the headache of registering for VAT and the paperwork, the extra paperwork you've got to do with VAT, all the way through your year, plus every 3 months you've got to send a report off to the VAT man, plus, when you think about it, if your money's coming in theory, you should put some of that money to the side, because in 3 months' time, if you're making a profit, you'll be giving the VAT man a big chunk of money. So you've got to save that money, put it aside.
So I understand that VAT is tedious, but is it
No, you don't need an accountant. No, there are software packages you can download. There are, I suppose, a software package is a good way to describe it. I mean, you can go to these big companies and buy a software package from them, and it'll probably cost you £500. There are people, I'm sure, that online they will say, well, we'll design an Excel spreadsheet for you, and we'll charge you 150 quid, and that'll do the job. But the thing is that you won't. By registering for VAT, you don't necessarily make more money, because if you go out and you buy something as a non-registered, non-VAT person, you pay £120 for it, you're going to sell it to Mr. Smith for 240. If you go and buy a piece of kit for £100 from somewhere, you'll pay 120, but it's actually only costing you 100. You then bill Mr. Smith £240. But £40 of that 200 you're giving to the VAT man, so you're still only making £100 profit.
Sure, but it doesn't affect Mr. Smith. He's also VAT registered.
That's true.
So I'm no more expensive to that company if I'm sticking VAT on top of my invoice, because to that company they don't pay that VAT.
That's right. Yeah.
So,
Yeah.
okay.
It's something. Yeah, I can see what you mean. A lot of people that I do their accounts for, they're all self-employed, and I've got electricians, plumbers, that sort of thing. So they're charging Mr. Smith. He is the end user, and as we know, the only people that are actually paying and footing the bill for VAT is the man in the street. So Mr. Smith has his house rewired. He gets charged VAT by the guy that's come around to do the work. He can't claim that back from the government, but everybody else up the line can. So yes, VAT for businesses is fine, it's good. And as you say, if you're working for a big company and you're sending them a £1,000 invoice with £200 VAT, they're not looking at it and saying, oh, we've just had a bill for £1,200. No, they're saying we've just had a bill for £1,000. And yes, you are claiming back the VAT on the items you've bought. It depends how much paperwork is involved in your proposed business. If you've only got half a dozen invoices a month, then at the end of the quarter you've got 18 invoices. And some purchase invoices against it. Yeah, it's not going to be difficult. But once you start on the VAT, you have to carry on with it. But as I say, you know, VAT is something that we can go through another time, perhaps. So, record keeping. Without accurate records, you won't know where you stand. It's always best to keep on top of the paperwork and not leave everything until the last minute. Similar to what I was saying about the VAT, keep the records accurate, keep them up to date, because then when it comes to do the return, it only takes you a couple of hours instead of, oh my God, where do I start now? I've got 3 months' work to get on. And you'll be sitting there for a fortnight and you won't be working at the same time. And if you don't get it back in time, you get the penalties. On the record keeping side, expenditure, this will include records of everything you have spent to do with running your business. There are two types of expenditure: capital expenditure, items that you would reasonably expect to be using in 2 years' time. I mean, I don't know how long a camera lasts, but if you buy a camera for a couple of, I don't know, £5,000, that is classed as capital expenditure. You can still get tax relief on it. But it has to be reported in a slightly different way on the online tax return. And then you've got your revenue expenditure, which is day-to-day expenses like travel costs, hotel and subsistence. Subsistence has exceptions to it. Subsistence basically means, say for example, you go away on a few days, go and work for somebody in Birmingham for a few nights or whatever, or a few days. And yes, you can charge yourself for the hotel costs and your food costs. But if you were to take out the person that was employing you to dinner and say, oh, I'll buy you dinner tonight and a couple of beers, you cannot claim that back as an expenditure against your business, because the HMRC say it's impossible to tell the difference between subsistence and entertainment costs are not tax deductible. Travel costs, that's the other one. If you were travelling from, it depends where you're based. When you register with the revenue, they say, where is your business address? Oh, it's my home, #1 Smith Street. So that, as far as they're concerned, that's your office. If you travel from there to Birmingham to do some work for 3 days for somebody, and then somebody else says, oh, could you come over to Manchester? I need all of those travel costs are covered because your base is your home.
Right, but so I'm not originally living in London, I'm living up Northamptonshire. That's where I would register myself from.
Yeah.
My postcode. But I'm based in London. I've been in like everyone here.
Mhm.
We're all based in London. I don't know if we're all from London. But so the taxman would think I'm working from Northamptonshire, even though I sleep in London.
But how can you be sleeping in London if you're living in Nottingham?
Okay.
So if the taxman wants to write to you, he's going to write to Nottingham. But you might not be there for 3 or 4 months. So it's not exactly your place of business, is it? So if you're living in London, that's where you're living. So in other words, you're trying to tell the taxman your home base, your office is in Nottingham, but you're hardly ever there. They will soon find out that, well, actually, let's put it this way. HMRC, they've been around for many years. They know all the tricks. They have been known, for example, with company cars, where companies have company cars and they say, right, well, this is a pool car, which means that there's no tax liable on that car when somebody in the company uses it. But if one person uses that pool car all the time and pops into Sainsbury's to pick up his groceries on the way home, and then he takes his kids out to the swimming pool on a Saturday afternoon, the taxman has been known to follow people for a few weeks at a time, because there are so many charges that should be paid on company cars that it's worth the taxman sending one guy down, right, you follow that car with that registration number, and you make a note of everywhere it goes for 2 weeks. The amount of money they will fine the company that said, no, we haven't, it's not allocated to an individual person. Plus there's national insurance that has to be paid on it, the company has to pay tax on it, the individual has to pay income tax on it, etc., etc. It's worth their while doing it. They know all the tricks.
So I don't feel like this isn't a trick. I'm in London and I'm living in a rented house, which is I'm working from.
But you're paying rent there, I presume.
Yeah.
Yeah. So you should, and you should be on the electoral roll, no? As living there.
So I should be registered from my current house that I'm in London, not my parents' home.
It's a very good question. But then, if you were then travelling from here to Nottingham, you couldn't claim that as business, could you? Well, you would like to think you can, because you've been here and you've been staying here, working here, but your base is up there. So your travel to and from Nottingham to London and back again, in theory, you would want to put through as an allowable expense. I guess that's what you're trying to say.
That's one thing. That's not the point of why I asked. Yeah, train ticket, everything comes on it. So that would be wrong. Is that what you're saying?
I believe it would be wrong, yes. Yeah. But I don't work for HMRC. And, that sort of question I haven't been asked that one before. I'll have to look that one up.
It's just weird because, I don't know, students, houses change every year or whatever, and it seems like, well, I've got my proper base up in Northamptonshire, but, that's where all the postcodes, all the bank statements and stuff, and that seems like the sensible thing to do. And I don't know, our rental agreement doesn't say we can use the property as a business place, so it would probably seem like it would be the wrong thing to do to be registered from my London house.
So when we do go away on, effectively work, how do we then do it? How do we tell them we're doing it from a London location? If we get a train ticket from London to Bournemouth, then, but say Max is registered in Northampton,
I can't answer that one. That's because if you say, you know, this is my home address, Northampton, but I'm never there. I only pop back once every 3 months for a few days. Yeah, I'll have to pass on that one.
My mum seems to be on my post, so that helps.
That's what mums are for. Yeah. No, I'll have to pass on that one.
Okay.
I'll admit you've stumped me on there.
Am I doing something wrong at the moment, though?
Well, I don't think so, because you're not trying to, well, I hope you're not. You're not trying to claim that you go up to you come down from Northampton every Monday and you go back every Friday, so therefore I'm putting in a claim for £100, for tax purposes. I think the best thing to do at the moment is to sort of just play it the way you've been playing it. Like, as you say, if you're going down to Bournemouth and you go and get a train ticket, yes, that's a legitimate expense. You're going down to Bournemouth purely to do some work. And then you're going to be coming back from Bournemouth, having done the work. So that return ticket or whatever, yes, you can use that as a deductible expense. It's just a question of the London to Northampton bit that's...
Just the London to Northampton.
Yes, because you're not really there. I know your address is there. You're saying you're domiciled there. I'll have to leave that one. Yeah, it'll be on there. And then if you can remind me, because I'm actually not going back home for until about 10 days from now. So. No, this is holiday. Well, no, this bit isn't holiday, obviously. Yes, right, okay. So that's that then, with a couple of questions.
Sorry, with anything that counts as, is 2 years, did you give that as an example, or is that a definitive thing on capital expenditure for the last 2 years?
It's a ballpark period. You know, if it's something that you would expect to still have and be using in 2 years or more from now, for example, I mean, I don't know how long cameras last, or recording equipment, or laptops, or, PCs at home, other equipment that might last 5 or 6 years. I mean, some companies buy equipment and they reckon it will last them at least 25 years. So that is capital expenditure, but then that's that specific type of business. Things that you buy that you would expect to be useless after 12 to 15 months. I mean, maybe, for example, you buy a printer for £150, but it's only going to print so many pieces of paper, and that in 18 months' time, you would have killed that printer. That's an ordinary revenue expense, because you won't have it after 2 years. You're not buying something for the future, and then the revenue looks at the future and says 2 to 3 years, that sort of thing.
And should we keep our receipts? You say keep all your...
Keep every piece of paper you have, yeah. Petrol, that brings going back to travel costs. With petrol, if you bought a car, for example, purely for business use, that will come out of capital expenditure. So you bought a car for £10,000, etc., and you can offset the cost of that car, the insurance, the road tax, the maintenance on the car, the fuel you use on that car. You can offset all of that, as long as that car is only used for business. You pop down to Sainsbury's, you're not using that car for business. Therefore, it is no longer, if you like, a company car. With the way I'm doing it is that I have a car, because I know the way these things work. So what you're allowed to do is claim 45p a mile. So when I drive up to London at 200 miles, I claim 45p a mile for that. It doesn't cost me 45p a mile in fuel. Probably 10p a mile. But the other 35p covers the cost of the insurance while I'm using it for business, the wear and tear, the servicing, etc. It's all a pro rata calculation, and the revenue has said you can claim 45p a mile, no questions. But you do not then claim for the petrol on top of that. Right. It makes it a lot easier.
Using that as an example, sort of like, I really want to buy a van.
Mm-hmm.
To use it for film shoots and stuff. How does a taxman know that, to say you know, like say I'm a film shoot, I'm on a shoot, and the first AD says, right, we need lunch, and he sends me to Sainsbury's. You know, it's that kind of stuff. Like how do you specify what you're using your van for?
With a van, it's different.
Okay.
It's different to with a car.
Right.
You can have a van and you can pay a little bit of tax on it, but you can use it for business mileage, personal mileage, go on holiday in it, take the family down to the seaside or whatever in it. With a van, it's different, but it's got to be a proper van. But in that particular case, if you had a car, say for example, I was sitting here and somebody said, oh, could you pop down the road in your car, go and get sandwiches for 25 people. So I drive from here down to Sainsbury's for 25 sandwiches and come back. That's business.
Right.
Because the person who's employed me has asked me to go and get that, etc., and come back, that sort of thing. I'm not driving home. It's not for me. My employer's asked me. My employer's paying me. I mean, one company I work for down in Devon, you know, I've got an hourly rate, and I said I don't mind if you want me to make the coffee, I'll make the coffee. If you want me to do the accounts or go and get the milk or go and get the coffees or whatever, that's fine. Because they know they're paying me an hourly rate, but they're not going to send me down the road to get the milk because it's costing them more than if they went themselves. You know.
What about rent and utility bills?
Rent and utility bills, if the premises are purely used for business, if it's a business premises, then that is all tax deductible. But if you're working from home, like I am, the revenue has a figure of, say you've got a 3-bedroom house, for example, and you're working from there. The revenue, I believe, has a figure of about £4 to £5 a week that you can claim a deduction for, and no questions are asked. But you cannot say, well, my utility bills are, let's make it nice and easy, £1,200 a year, and I work at home for 2 months of the year, therefore I'm going to claim £200. Because like if you have a mortgage on the property, the mortgage lender might not want you to be running a business from the property. If the house is insured, well, obviously the house will be insured. The insurance would want to know you're working from home. You probably have to have it anyway in your line of business, public liability insurance, because if somebody comes around to see you and they fall down the stairs, they can sue you, and so you need that. So as I say, they have a figure that it's much easier to do and say it's £4 or £5 a week. Yes, it's not a lot of money, but it depends on the amount of hours you work in your place, in your home, each month. There's a calculation on their website, which you can have a look at, and it says if it's up to 12 hours a month, you can claim £10 a month, and things like this. It's all scaled according to the amount of time you spend there. It's a lot easier than saying, because you know that you wanted to claim a percentage of your utility bills, heating bills and that sort of thing, because then you've really got to prove it, and you have to tell your local council that you're running a business from your home, that sort of thing. If you wanted to go into that, that would be something you'd have to look into. But it's sometimes easier just to say, well, they'll let us have £5 a week, I'll claim £5 a week. And let's face it, is it actually costing me any money to work from home? No, it isn't, because I haven't got premises elsewhere. I'm not travelling from home to those premises and all that sort of thing. If your business gets bigger and bigger, yes, you will need bigger premises. That's the time to think again. But then you'll be claiming expenses on the business premises, not on your home, because you'll only be living at your home. Your main point of business are your business premises.
If we bought equipment a couple of years ago, can we use that as an expenditure now if we're writing off against what we've earned?
I believe so, yes. I know that you can, with VAT, for example, if you started off, I didn't want to go back to VAT, but you can go back 4 years with VAT. So if you bought something 2 years ago, you obviously weren't VAT registered. You've bought that piece of equipment, you paid VAT on it. You can, if you register yourself for VAT 3 years, well, up to 4 years after you bought that, you can claim that VAT back on that purchase. So I would say that yes, you can have, because yes, you can, because you're in preparation for becoming self-employed. So it's all part of the prep work. You haven't yet become self-employed, but that is your aim, that is your target. I mean, you can't go back more than 4 years. Because also the other thing is if you bought something 4 years ago and you've still got it, then that would be classed as capital expenditure. Yes, you still get the tax relief on it, but there wouldn't be much that you would have bought you know, over 2 years ago that would that you probably still have that would be usable. Next one. This is the easy one. It's very simple. You need to keep records of your income. So any money you get, you would be sending invoices out. You will have a copy of that invoice and should keep a copy of the invoice. Presumably people will pay you to your bank account, so you could keep your bank statements as proof that you've had the money, etc. And again, good old VAT. VAT records, accurate records are even more important. If you don't do it right, you'll get a bill. And they will keep sending you a bill until you get it right. There's one company I'm working for, they've just had a bill for £1,300. Only a small company, because they didn't get their VAT returns in on time. And then they ignore the letters that came through because they're not accountants, and that's how these things mount up. The most important thing in running your own business or running any business is cash flow. Cash is king. So if you were buying, going back to the previous scenario, if you bought something for £100 and sold it for £200, great, I've made a profit of £100, fantastic. But you haven't actually made that profit until that money's been paid. Well, I mean, yeah, exactly. Until the money arrives in your bank account, you could make as much profit as you like. There are two contributing factors in cash flow. As it says there, being a new business, you probably won't have a credit history. Suppliers may be unwilling to open a credit account for you because you don't have a credit history. So you go out and you'd have to pay for whatever you wanted to buy. And the other thing, of course, is that some of your customers might want to hold on to their money a bit longer than you would actually like. As I said there, it's not uncommon to have to wait 30 days or more for payment. A lot of companies nowadays are saying, well, you know, we don't pay for 60 days and probably even 90 days. If you think about it, you've been out, you've bought some materials or some equipment, and you've paid £1,000 for it, and you've got to wait 3 months to get any money back in. That's what cash flow is.
What if on your invoice, because whenever I send the invoice, I always say, please pay this amount within 14 days. So if they won't pay within 14 days, or like 30 days, can I take any actions and just say, like, it was stated of the invoice?
You can take the action, of course. But what you have to think about is, do you want to work for those people again? Do you want to annoy them, irritate them, so that they pay you within 14 days? Oh, well, we're not using her again. We don't get much credit out of her. We'll go and use him. You know, it's a very difficult balancing act as to how far you take it. I mean, my invoices have please pay within 14 days, and the people I work for know that I'm self-employed. I'm not part of a big company and etc. And most of the time I get paid within 2 weeks. But if I don't get paid for a month, I have to then make that decision. Do I want to work for those people again? Because if I do, then I'll just say, you know, you can just phone up and say, any idea when you're going to pay me? And if I don't want to work for them again, then they get a letter from me saying, if you don't pay me within 7 days, I'll take alternative action to get my money. And then they pay you very quickly, and then a month later they'll phone you up and say, could you come and do some more work for us? But that's a very difficult, you have to judge that yourselves, you know, with whoever the one that isn't paying the bills.
What is the next step if you said 7 days, you send them a letter? What is the...
There's a website called... Thank you. Yeah, it's the small claim. You go onto the website, the Small Claims Court, or Small Claims, and it's so easy to do. It's ridiculous. You just have to fill out the form online, say who you're claiming against, what you're claiming, why you're claiming it, and explain. You have to explain there that your payment terms are 14 days. It's now been 4 months. You haven't got the money yet, and you can also add interest on there. I think it's round about 8% over Bank of England base rate at the moment. So you can put it's quite legitimate to put that claim in there. You can also put in a claim for the court fees. Oh, well, you have to pay depending on how much you're claiming of these people, it's a sliding scale of how much the court fee is that you have to pay. But you put that court fee on the claim. And if you've been in contact with a solicitor for advice on what you should do now, and the solicitor has charged you, say, £100, you can put in their solicitor's fees £100. And that person will then receive that once you've pressed the button on the website. That person is deemed to have received it, I think, 2 or 3 working days after you've pressed the button. So that notice has then been served on those people. Now, they can't just turn around and say, oh, you know, we didn't pay your bill for £1,000, here's £1,000. Yes, you can accept it, but legally they need to pay the £1,000 plus the interest, plus the solicitor's fee, plus the court fee that you've had to pay, which could bring it up to £1,200. And then you discharge, once you've received the money, you discharge that in court. But if they don't pay after that, you can tell the court they haven't paid, the county court judgment will go against them, and it's then in all the records at Companies House and all this sort of thing, and their name is mud, and nobody will let it go that far unless they haven't got any money.
If you're not earning over £5,900 or whatever the figure is for paying tax, do you have to put a unique tax reference on your invoice? Because I originally had an issue with an invoice where, because I don't earn enough, I sent them my invoice with just my bank details, as I have done before, and it's been fine. But with this client, they basically said they can't pay me because I didn't give them the unique tax reference. And when I sort of said, well, I don't need to give you that, they were then it was Ravensbourne. They were then adamant I had to go through their payroll, but then that still would have reduced the tax. But I was done on a you know, they were going to give me this much money to make a film, and that was it.
Mm-hmm.
So I sent them an invoice, but they basically took 70 days, well, they still haven't paid me, for the film. And the reason they said it took so long, it's taken so long, is because I didn't fill out the pay claim form, when for sort of work they've commissioned me to do, I should give them an invoice, surely.
You should give them an invoice, but nowadays more and more, it all started in the construction industry quite a few years ago, because there was so much of this sort of work going on. You know, cash here, bit of cash there. The government, or HMRC, clamped down on that and decided that anybody that's self-employed has to have a UTR, unique tax reference number. So everybody went out and got one. And then the revenue then decided as to what sort of person you were, whether you could have tax deducted at source, as in you, for example, you go and work for the BBC, you've got a UTR, you send a bill off to £1,000 to the BBC, and the tax man within that UTR, when the BBC put that UTR on the HMRC website, that will then say that, John Smith, you deduct tax at 20%. So the BBC would only give you £800, but they paid £200 to the taxman. Then the other type of UTR, they're all the same. You would never know from the number, but you know what when you have your UTR, you will know whether you will have tax deducted or not. The other one is that for example, me, I have a UTR, just like any other self-employed person. But in the industry that I'm in, there is no question about any tax being deducted by my employer. And I say employer as in the people giving me the job, not an employer as in full-time employment. So that's probably why Ravensbourne have not paid you as quickly as you'd like to have been paid, because they don't know what your UTR number is. They don't actually have any proof that you're self-employed. Because if, say for example, I was to employ you to make a film for me, I would need your name, your address, your national insurance number and your UTR. And with that, I go online and I have to now check with HMRC as to how I treat you. Obviously, I treat you very well because I'm a nice guy, but do I take 20% tax off your invoices and give that money to the tax man and you only get 80% of it, or do I just give you the 100% and I'm happy? And when the first one I did here at Ravensbourne earlier this year, I sent them all my details, bank details, here's the invoice, thanks very much, please pay within 14 days. And I got an email back saying, oh, we need to have your UTR. Okay, fine. Here's my UTR, 10 digits. Thanks very much. Yeah, I got paid in the week after that. It's not a top secret, you know. It's
Well, no, it's, I mean, I sent them the invoice and it took them 60 days to say, oh, we need your UTR. To which, you know, I didn't know what it was, so I had to ring home and find out what it was because my paycheck from a bar job I had get sent home. To which it was kind of like, well, why do they need your UTR?
Well, in this industry, I only found out quite recently it's similar to the construction industry, but there's an easy is not the right word. There's a way out of it. It actually comes up later in here. Let's leave that one for the moment, but I'll come up to that, you know, later on. There's a couple in a few screens time. Yeah, why not? It's not top secret. You're not giving away personal information. It's not like data protection or anything. And also, then they can't come back after a month and say, actually, before we can pay you, I need to have this bit of information, and then another month later, or we need that information and all that. You don't necessarily need to put your national insurance number on it, but your UTR, that's the one that everybody is now saying, oh, that's the important one.
And they need that so they can
Check your status as to whether HMRC want them to deduct 20% tax from any bills you send them, or they pay you gross.
And do they have to check? Because what if they don't check and they just pay the invoice and you only get, you know, 80% of your fee? But for me, I haven't earned enough, so I'm entitled to the full amount.
Yeah, but you have to keep a record of the fact that you've billed them 1,000 and you've only had 800. Therefore,
and then you can claim it back.
Well, therefore, when you do your tax return, you can say that you have had tax deducted at source, like you do with if you're employed, you've had tax deducted at source of £200.
But still, you only do tax return once you earn over a certain amount.
Nope.
What? So you get?
If you're self-employed, you do a tax return.
Even if you earn 100 quid a year.
Yes.
You get 20 quid taken away. Like before you earn it.
If that's what your UTR tells your employer, like Ravensbourne, to do, and you do a job, well, the thing is that you might work for 50 employers through the year, or you might have 50 clients, not employers, 50 clients. If each of those clients is told they have to deduct 20% tax, and you do you do a job for £100 for each one will take £20 out. Yeah. And at the end of the year, if you've only earned £5,000, you're beneath the tax threshold, so you'll actually get that 10 or 20 or 50 lots of £20, you'll physically get that back at the end of the year.
They will give you back.
Oh yeah, because you can earn £10,000 a year and pay no tax. But at the time you're sending out your invoices, nobody knows whether you're going to earn £10,000 a year, 20,000, 30,000 or 5,000. You've got to start somewhere. All they're trying to do with these 20% tax deductions is just to make sure that you don't spend it all, so that they're going to get their money at the end of the year if you have to pay tax. And if not, they're quite happy, they'll give it back to you. Okay. Yeah. So we work with cash flow, weren't we? So this, I think we've done most of this really. Agree payment terms with your customer, as you said, you know, the thing to do is to agree the payment terms before you do the work. Not going, great, lovely, I'll come and work for you for a month, and then you send them the invoice and it says, please pay within 14 days, and they turn around and say, well, we don't pay 14 days, we're 3 months, we're 90 days. And then you say, well, if I'd have known that, I wouldn't be working for you, because I can't do the work and not get paid for 3 months. So agree the payment terms in advance. I come and work for you, when are you going to pay me? As soon as you finish the work, get the invoice out to them, because then they'll remember who you are. Well, you know, if you send it in 3 weeks later, because you're only going to get round to doing your paperwork once a month, for example, they'll look at the invoice and say, who was that? What was that for? Oh, I see him. Oh, he's on holiday this week. Oh, leave it in his tray. He'll be back next week. So it delays when you're going to get paid. If you've done a job this week, do the invoice this weekend, then go down the pub. But get it ready, get it out there, so they receive it within about a week of you doing the job. And if you've got a job that's going to take 4, 5 or 6 weeks, and you can agree that they'll pay you within a week of you giving them an invoice, can I give you an invoice at the end of every week. So you then get paid every week, a week in arrears. So if the total bill is, for example, £5,000 over 5 weeks, you can't wait 7 weeks to get your £5,000. So send them an invoice every week for £1,000, and if they pay you then within 14 days, you're getting your nice little £1,000 coming in every week for 4 or 5 weeks, very close to when you've actually done the work. So your cash flow, if you like, is a lot healthier. Right, here we come to the invoices. That's one of mine. My name and address, I mean, it's just a boring standard. You know, I don't have letter-headed paper, that sort of thing you might have. That's up to you. You know, I don't need it for what I do. So that's me in the top left-hand corner. The company that I've done the work for comes down next. What I've done for them, see, week ending the 30th of March 2014, I give them a bill once a week. No VAT, well, the only VAT mentioned is in the top right-hand corner. Le Queux & Co is not VAT registered, so that they know that I'm not charging them VAT, therefore there's no VAT for them to claim back. It's almost irrelevant, really, because I send them the invoice and then I'm the one that processes it in their office, because that's what I'm doing for them. So you can see the unit price, £872.50, and down there's please remit payment within 14 days, and in case you keep forgetting, my bank details, there they are. So they've got no excuse. In fact, you mentioned the UTR number earlier on. I didn't put it on there because they don't care. And also, as I say, within accountancy, it's not one of the industries that the taxman is targeting, that the taxman is looking at. Construction industry, if you don't put your UTR in there, forget it, you won't get paid. And it would now appear that in this particular industry as well, media, etc., if you don't put your UTR on there, you won't get paid.
You say they don't care, so they just pay £72.50?
No, £872.50. Yeah, I know, it's not that big, yeah.
They just pay that, and it's down to you to tax yourself effectively in your self-assessment?
Yes. Yeah, I declare that in my return on the 5th of April, or as up to the 5th of April, yeah.
So if the company doesn't deduct tax from you, you've got to tax yourself with your self-assessment, and also mention that those companies have taxed you, and say you're under £5,000 or whatever, they incorrectly taxed you, those ones that take 20%, and that's when you get your check.
Well, they haven't incorrectly taxed you.
No, okay, not incorrectly.
Yeah, yeah, if you're only going to earn £5,000 this year, and because of the status from your UTR tells that employer, that client, that they have to deduct tax from you, they'll deduct the tax, send it off to the taxman with your name on the end of it, with your UTR number, and at the end of the year, when you do your tax return, you say, right, well, my gross income, my gross sales were £5,000, and I had tax deducted by employers of £250. Therefore, you know, I want it back. That's all done on the form online. And if you do it online, you will get the refund in 4 days.
Great, okay. Now, in my specific situation, I'm close to sending off my self-assessment for 2013 to 14, that year.
Yeah.
There was a mix of freelancing and bar work for companies
Yeah.
that taxed at 20%.
Yeah.
Now, I just received a tax refund check from the bar company, the bar, right, for 80 quid. And should I cash that, or because I don't know whether or not to cash it, because I've still got, HMRC basically don't have all my information yet. They've only got the companies, they've not got my declared.
So the company has issued you a P45, presumably, and you don't work there anymore. Is that right? Because if the company, the bar, has sent you a refund, they must presume that you're not going to be working for them anymore.
Yeah, I'm not working at that bar anymore.
So they've sent a check to you made out in your name.
Yeah.
Yeah, so you should bank that anyway, because you might, well, because it's your money. It's tax that you've had deducted from your pay at that bar.
Okay.
or it's a refund of tax.
It's calculated from that company, and that my work for that company only, not the big picture.
Not the big picture, no. No. And when you've, well, as I say, because they've sent you a tax rebate, they should also have sent you a P45. And on that P45, it will say that you've earned £1,000 and you've paid X amount of money in tax. Now, if the tax you paid was £82.50 or whatever the figure was, that figure will now be zero because they've given you that £82.50 back.
Sure.
So when you do your tax return for 14-15, that you will have to declare the money that your gross pay from the bar and how much tax they charged you, which in this case would sound like it's probably zero. And then you would have to declare your sales of the sales in your self-employed business, the costs associated with your self-employed business, and then the machine will go that minus that equals that. And then the taxman will then look at that and say, right, well, how much income has he had? What's his profit been? His tax allowance was £10,000 and he's earned £10,000, therefore he doesn't have to pay any tax.
I feel like company number 1 out of 10 beat to getting the tax they took from me back to me. Do you see what I mean? So because I haven't sent my self-assessment for that year off yet, which would have said obviously I was taxed by the bar, can I have it back? They've already given it back, and then you see what I mean? It's that I'm a little bit confused about whether I should cash that check because, especially when it's like earnings borderline taxable.
So there sounds like there's more to this than, because an employer shouldn't be giving you a tax refund unless it was relating to this tax year.
That we're currently in.
So 14-15, yeah. Because anything up to the 5th of April this year, 2014, would relate to the last tax year.
Yeah.
So from the 6th of April, we all start off with zero. Everybody starts off with zero, whether it's your employer, whether it's you, or your grandmother. So from the 6th of April onwards, if you'd have worked at the bar for 3 months, and then you didn't work there, but they thought you were coming back, and then at some point, presumably at this point, you said, actually, no, I'm not going to come back, they would then do a final payroll for you, and then they've taxed you for the first 3 months as if you were going to be working for 12 months. That's the way the systems work. So you worked 3 months, they charge you a bit of tax. You didn't work the next 3 months, and then they said, right, he's left. Therefore, they've only paid you for 50% of the time, that time frame. But they've taxed you for 50% of that time. But you haven't earned any money for that bit of 3 months. Therefore, that's why you've got your tax rebate. It's your money. It's got your name on the check. Yeah.
I just want to cash a check, which had been sent to me on the assumption that I didn't need to pay that tax. And then I, further down the line, it emerged that I do need to pay tax. And then I basically been refunded for something that I shouldn't have been refunded for.
Well, as I say, if it's come from your ex-employer,
Yeah.
then I would hazard a guess and say that it's absolutely fine, it's your money. And when you do your tax return next year, yes, you might have to pay that £82. It depends how much money you earn this year, though. So anyway, so that's an invoice without VAT. Nice and simple, nothing complicated. That's an invoice with VAT, slightly more complicated. The person sending the bill out is stationery and computer marked, and if that was you, you would have to put your VAT registration number on it. Doesn't necessarily have to start with GB, but that's the way it is in the UK. And then the bill's being sent to Peter Young. Whether or not he's VAT registered, we don't care. It's up to him. So even though the system allows you to put his VAT registration number in there, on this particular software, you don't need to put it in there. It's up to him if he claims his VAT back. The VAT man knows whether he's registered or not, etc. When you're sending out VAT invoices, you have to state the VAT rate against any items there. So this is your net amount, your £98. There's a 20% VAT rate, and the VAT is £19.60 on that £98. And then the VAT has to be perfectly clear on each invoice. So the total tax amount is £180.61. So the goods are 903, Therefore, your total bill is £1,083. That's going back to the conversation we had earlier on about the VAT. It's if you're VAT registered, if Peter Young was VAT registered, it's actually only costing him £903. But if Peter Young was Mr. Young who lives around the corner and you've built a computer for him, because he wouldn't be VAT registered because he's just a man who lives around the corner, it's actually costing him £1,083. Because he's the end user, and as we know, it's the man in the street that ends up subsidising the VAT for the government. The one thing that is missing from there is he hasn't put his payment. That Stationery and Computer Mart haven't put their payment details on there where they'd like the money. That can only delay payments. Don't give these people any ammunition to turn around and say, well, we didn't pay you because we didn't have your details, because we didn't have your UTR number on there. To give them everything up front, straight away at the beginning, and they've got nothing to argue with. So, as it says, accurate record keeping will show at any point whether or not your business is profitable. As long as you keep all your receipts for your expenditure, you know what you're invoicing to people, you'll know exactly where you stand. And not only that, they'll always also form the basis for your tax return at the end of the year. And if you keep everything up to date, your tax return at the end of the year should take you about 2 hours. And then you can forget it for 12 months. It is very, very simple to do the tax return. People think, oh my God, and now we've got to do it online? Well, you don't have to do it online yet. Not everybody. You can do them on paper, but you've got to get them in by the 31st of October. If you do it online, you've got until the 31st of January, but also by the 31st of January, you would have to then pay any tax that you owe the taxman in one go. I did my tax return at the end of May, I think it was, and I know what my tax bill is that I've got to pay by the 31st of January, so I've already starting to siphon money off from my ordinary income just to cover that. Plus I'm siphoning off money, not siphoning, that sounds like money laundering. I'm putting money aside because I know roughly what my tax bill is going to be next year as well, because I don't pay any tax, I don't have tax deducted, at the 20% rate by the people I work for. Done that one. Yeah, I've seen several examples of people who've worked hard all year long and leave their paperwork until the last minute. When they then sit down and sort through it, or hire an accountant to sort it, at great expenditure, then they realise they haven't made as much profit as they thought. Some have even gone out of business. If only they had kept at least monthly records, they could have taken steps to avoid this. Yes, it's boring, keeping bits of paper here, there and everywhere, but it will only do you good. It won't do you any harm. This is a simple profit and loss statement. It is, very simple. Sales income, also known as revenue, also known as turnover. That all basically is all the same thing. So when we're talking about registering with VAT, or when you go out and say you went out and did one job this year, and that job you billed the person £29,000. I'm sure you'd love to go out and do a job like that one, once a month. So what the taxman wants to see is what your turnover is. And that is the figure that if you come up to the 79,000, that's when you have to register for VAT. You've got the various costs against those sales. So your total overheads, which is this lot, is £9,890. So your pre-tax profit is £19,358.
That's what that person earned that year.
Yes. Yeah. So his turnover, his sales, his revenue was 29,250, but his pre-tax profit was 19,000 odd. Oh, oops, a daisy. Right, so that's your profit and loss for the year. The important dates for self-assessment, as it says on the screen, 5th of April, that's the end of the tax year. Nobody's been able to tell me why it was the 5th of April and not the 31st of March, which would seem a lot more logical. I don't know any software systems that will run a financial year that ends on the 5th of April. So people that say, well, I'm going to go to the 5th of April, but actually I'll do everything to the 31st of March, because that's the way my software works. 31st of July, second payment on account of income tax. I'll come back to that one in a minute. It's only that because that's the date, the order that the dates come in the year, obviously. 31st of October, that's when you have to have your self-assessment tax return in by, if you're doing it on paper and putting it in a funny little brown thing with a little window on it, and you go and buy a stamp for £6.50 or whatever, and you send it off to the taxman. 31st of January, much easier, self-assessment tax return due if you complete it online. And also on the 31st of January, payment of tax due from the previous financial year. So, yeah, well, as in this, so let's say 5th of April 2014, end of the financial year. You've got to get that tax return in. Let's forget January, because that's on paper. Nobody uses paper. On the 31st of January, you send your tax return in. 31st of January 2015, you send your tax return in up to the 5th of April 2014. But it's a bit late, really, because on the 31st of January, if you send it in on the 31st of January, on the latest possible date, only then will you know how much tax you owe. And by the time you sent that in, and they say, oh, you owe us £1,500, you can't pay it now, because it's gone 6 o'clock and online payments are finished. So now you're into a penalty situation, because you can't pay until the 1st of February. They will charge you £100, because you've paid it late. That's another reason, don't leave it until the 31st of January. So they look at your profit and say, right, you owe us £1,500 tax up to the 5th of April 2014. So you've got to pay that on the 31st of January. They will then say, because you earned £1,500 tax in that tax year, you're probably going to earn £1,500 tax in the next tax year. So not only will you then have to pay the £1,500 tax up to the 5th of April 2014, but you're making a payment on account of £750, 50% of that tax you have to pay in January 2015. So you're paying tax up front for the year that you're now in, for 14-15. Yeah? Then in July 2015, you will pay them another £750 tax. So in theory, you've already now paid your income tax for the year 14-15, right? So when you do your tax return on the 31st of January to the 5th of April 2015, and you work it out, let's say your income was exactly the same. You owe them £1,500 tax, but you've already paid them £750 in the January. You paid them another £750 then, so you don't owe them anything. But they'll say, right, on that, because you earned that amount of money and you made you had to pay us £1,500 tax, which you've already paid in advance. You can now pay us another £750 in January, which is a payment on account for 15-16. And if that doesn't confuse you, nothing will.
And if you don't earn as much, they'll refund you?
Yes. Or you can carry it forward. Leave it on your account. Okay. We all have accounts with HMRC, and that is your UTR. Like a tab, yeah. But they won't allow you to run it in minus very much. It's got to be in credit. So, but as I say, for more detailed information, there's a website down there to do with deadlines and penalties if you don't get the stuff in by the dates they want them to get. They want you to get everything in by. Right, so going back to the original screen, the profit for the year was £19,000, and this year's allowance is £10,000. So the profit less the personal allowance is £9,358. So you will be taxed at 20% on your profit less your personal allowance. So 20% of 9,358, £1,871, which you would then have to pay on the 31st of January. And they will charge you then half of 1,871 as well at the 31st of January.
So you're saying everybody's allowed to profit, like have as profit £10,000
Tax-free income.
tax-free income.
Yeah.
But at £5,000, whatever it was, they do have to pay their national insurance.
Yes. At £2.75 a week.
Yeah.
£5,338, I think. But that's nothing to do with it. The taxes and national insurance that you pay do not affect that figure. They don't affect that figure. You can't say, yeah, but I paid £2.75 a week for the last year. There's £300. So I'll take £300 off. No, you can't, because it's a tax. You can't deduct. You can't claim the tax as a taxable allowance, because that's why you're being taxed.
What about accountancy tax?
Yes, you can claim those as a tax deductible allowance. Yes, I'm pleased to say. Otherwise, I wouldn't be here. No, I mean, it would be very difficult for me to do any of your tax returns because I live 200 miles away. So I'm doing this because I know somebody that is a freelance person here, and he said, what would you think about doing it? And I think it's good practice for me. Might cut down on the amount of time I spend talking, I think. But so that's that one. So that's your tax liability for that year. Then we come to the national insurance liability for that year. So I've ignored the £2.75 a week because everybody has to pay that once you're earning more than £5,338 a year, whatever that figure was. So the Class 4 national insurance, there's the profit we had before, 19,000. On Class 4 national insurance, you can earn up to £7,956 and not pay Class 4. So therefore, you've got your profit of 19, less the allowance is 11,400. You pay 9% of £11,400 of national insurance, so you've got to pay £1,026 in national insurance, which gets added to the £1,900, yeah, that we had on the previous tab. Again, you've got to pay that by January. And again, they will say, right, well, you owe us £1,000 for last year, so we'll have the £1,000, and you can pay us £513.09 on account. You're increasing the balance on your tab. And then in July, you will pay another 500.
So national insurance is also done on account?
Yeah. Oh, yes. HMRC have been working on this for years, and they think it's a perfectly acceptable solution.
If, say, then you're required to pay more or less national insurance after you've already paid it, would you then pay it on the next instalment?
Yes, or you'd reduce the next instalment if, I mean, for example, if, say for example, there's your profit for this year. Say you already knew by January that your profit for the next year, 14-15, is only going to be half that because you've been ill or something. You haven't worked for 6 months, or you've been abroad, you've been to the Bahamas for 6 months lying on a beach. At the point in January, but don't leave it until January, at the point you're doing your tax return, when it says you owe us £1,900 income tax, you owe us £1,000 national insurance, therefore, basically that's £3,000 plus £1,500, don't forget. So you owe them £4,500 in January. Don't leave it till then, but because of the payments on account. You can say, right, well, yeah, okay, last year's figure was correct, but this year I've been ill, I've been on holiday or whatever. I'm only going to earn £10,000. I'm only going to have a profit of £10,000. They may turn around and say, well, okay, well, we'll reduce what you need to pay in January then. They'll still take the £1,900 and the £1,000 because that figure isn't changing. All you're trying to say to me is that, yeah, but for this year, this current year, that's going to be down by half, by 50%. But if you overpay, they will give it back to you.
In a sort of like, if you were having a year a lot more than previously, I mean, those are not particularly like want that sort of kind of, like, if the money's not mine, I'll get it out of my account.
Hmm.
Pay them, and then just bag it out of it.
To be honest, every time, even before I became self-employed, every time I've phoned and spoken to people at HMRC, they've been really nice. As long as you treat them the way you would like them to treat you. If you phone them up and have a nice little chat and you're very polite and say, I wonder if you can possibly help me, I'm not really quite sure how this works and that works, they're not going to turn around and say, no, clear off, just pay the bill. you know, they're not out to try and screw anybody unless they think they're being screwed. You know, so if you want to go up with a, you know, some sort of story about how much your income's gone up, or it's actually not going to go up so much this year, it's going to go down, or I'm having a break and that sort of thing, it's just a question of talking to them and saying, you know, I don't really want to have to pay all this up front because I don't plan on working. I'm not planning on working for the next 6 months. You know, it's just communication between everybody. But anyway, getting back to this then, so the bottom line then, your turnover, I think, was 29,000, something like that, I think. There's your profit before any taxes. There's the £1,800 tax there you're going to have to pay. There's the £1,000 national insurance. So your real profit is 16,000. That's the actual money you will end up in your pocket at the end of the year, and everybody's been paid. But obviously, out of that 16,000, don't forget there's the payments on account for this year, which will be another, well, £1,500 roughly, £1,400. But then at least you're paying it up front. Next year you won't be in the same situation, because once you start paying up front, you're just playing catch up all the time, you know. And at the end of the day, it'll all come out in the wash. When you get to the point of your business expands and you want to take on people to work for you, you do not have to be a limited company to take on employees. You can still be self-employed, but you have to register with HMRC on there. Well, and you tell them, you know, you have to tell them that you're taking on an employee, and you will need this real-time information. It's something they brought in to just over a year ago, where every time you pay an employee, you have to tell HMRC what you've paid them and what you've deducted every single time. It used to be done once a year, and it would take months and months for HMRC to come back and make sure everybody's tax codes were right and everybody paid the right amount of tax and right amount of national insurance and all that. They now say that this RTI, real-time information, everything is accurate. As soon as you've paid somebody, they know about it, and everybody's records can be kept accurately. I won't disagree with them. And on the next one, oh, hang on. There's something gone missing. Taking on the employee. Hold on a second. There's a business close. Oh, yes. One thing you have to consider is that if you're taking somebody on and you pay them £100 a week, it is costing you more than £100 a week. It's going to cost you £113.08p. No, £113.80p to employ them, because you pay employers' national insurance, and that's 13.8% of what you're paying them over a certain threshold. Yeah, there we are, over £7,956 a year, which, if we go back a couple of screens, that's when you would pay Class 4 national insurance contributions over £7,956. In a couple of years' time, every employer will have to contribute to a pension scheme on behalf of their employees. I think the last batch of employers, which is something like under 50 employees, comes in 2017, and at the moment they're saying it's only going to be 1% of what you pay them, but that will increase over a certain number of years, and it will go up to 5%. So if you're paying them £100 a week at the moment, from 2017 you'll be paying them £101 a week. Well, you won't pay employers' national insurance because you're not going to hit £7,956 a year, but just as an example. And a couple of years later, you'll be up to paying them £105 a week without actually having given them a pay rise, and without them probably producing more than they were when you first took them on. So it's all these sort of things that have to be borne in mind. Plus, you have to make sure that they're legally entitled to work in the UK. That covers everybody in the EU. But, for example, the company I'm working for, they've got 2 Hungarians working for them. They had to jump through hoops to get all the right paperwork, because although Hungary has been accepted into the EU to a certain extent, people still need work, not work permits, but they need permission to work in the UK, all that sort of thing.
So say I employ Ollie on Friday,
Yeah.
and I'm not earning up to £7,000 as someone self-employed.
Yep.
And I then pay him, and I've signed up to do this.
Yeah.
I don't have to pay employers national insurance.
It's not because you're earning seven. It's not because you're not earning seven.
I'm not
It's
paying out up to £7,000.
as long as he's not earning from you £7,956. Yeah.
Oh, okay.
Hmm.
Yeah, and it's not even if he's earning over 7, it's as long as it's not from me.
If he's your employee,
Yeah,
he's on your books,
yeah.
so you pay him his £100 a week. So he's only going to earn, let's say, £5,200 a year. You don't pay employers national insurance. He won't pay national insurance. He won't pay tax on that employment. If he's also working for somebody else for £100 a week and somebody else for £100 a week, it's all going to mount up.
But then that will be he will pay.
That's down to him. You don't need to worry about that. All you need to worry about is what you as an employer pay him.
Okay.
Yeah. The other thing is, of course, with employees, you have to take out, you've got to do health and safety, you have to do, you've got to have employer liability insurance, or employee liability insurance. There are lots of responsibilities you have just because you say to somebody, oh, come and work for me. It's not that simple. But that's something you need to look into, and that doesn't affect tax. That's just an aside, because it's something you need to think about before you do take employees on.
If you employ them, but rather than employ them, if you take them on as a freelancer to work for you,
Then you would have to have their UTR number, and then you'd find out from HMRC whether or not you would have to deduct tax from them and then pay that tax over to the taxman. And again, I think it's actually the next screen, I've slotted it in the wrong place. It comes up on the next screen about this tax deduction that you as an employer or the people you work for having to take tax from you. Have I done it the right way? Limited companies. It's taken me some time to get this stuff together, but the last one I came and did the last presentation earlier on this year, the question was asked about, I said, well, why do you feel the need to become a limited company? And nobody could really answer it. And they said, well, because everybody else is.
You can get a credit card with
You can get a credit card without, can't you?
But do you get different? And then
No.
it's just your credit card that goes downhill if you become a limited company. If you go bankrupt, it's no.
Well, yes, but how can somebody who's self-employed go sort of, with what you guys are planning on doing, how can you go bankrupt, really? Exactly. But the thing is that apparently, as it says in here, a production company, well, and you as employees of, not employees, as subcontractors in this industry, you're working, let's use the BBC because we've all heard of it, you go and work freelance at the BBC. Ideally for them, if you bill them £1,000, it's a lot easier if they pay you £1,000. And for you to get that £1,000, you have to have a Schedule D letter. Now the Schedule D letter is a letter from, I believe, from HMRC that states that the BBC can pay you without any deduction of tax. Apparently these Schedule D letters are becoming increasingly difficult for freelancers to get. Apparently these Schedule D letters are also known as a lorimer. Anybody heard of a lorimer? Well, that's what somebody told me who's a cameraman. Because if you work for the BBC and you send them a bill for £1,000 and they have to deduct 20% tax, they'll pay you the £800. They've then got to keep the £200 back, and once a month they've got to send that £200 plus all the other £200 from all the other people that don't have this Schedule D letter. They've then got to send that off to the taxman. That's so much more paperwork, and it is a pain in the neck. They've got to keep records of that. Whereas if you send them an invoice and they pay you, that's the end of the conversation for them. That's finished. And production companies openly admit that they would rather pay a limited company than a freelancer, because a limited company can be paid gross. And I'm led to believe that that is why one person on their own would become a limited company in this industry, purely so they can get work for these production companies, because they can pay you gross and they haven't got to do much more paperwork.
And if the website is we have VAT, but if they're both VAT registered,
Doesn't matter. Well,
yeah.
It doesn't matter. If you bill them £1,000 plus £200 VAT, they'll pay you £800 plus the £200 VAT. They will still deduct 20% of your net amount.
Sure,
Yeah.
VAT still paid, but
Yeah.
that cameraman who's VAT registered, who just paid £200 to rent a camera and then charged him VAT, he saves that because he's VAT registered.
He gets the VAT back on it, yeah.
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 Okay, so that's the benefit of being VAT registered. One, is that
Yes.
saving that
Yeah.
20%?
Yeah, but you don't need to be a limited company to be VAT registered. You can be VAT registered as an individual. This is pure, this Schedule D letter, that's what these freelancers, that's what the production companies want to see. Otherwise they're increasing their paperwork. They don't want to be bothered. You know, it's a pain in the neck, having to deduct tax, and then once a month by a certain date they've got to send that tax over to the tax man and say, here's £1,000, there's £200 for John, £200 for Bill, £200 for Jenny. They've got to do that every single month, every single time they pay people where they have to deduct the tax. And that is what I've been told, that's why they would rather pay a limited company, because if you're a limited company you get what you've billed, basically, and they get a bill for £1,000, they'll pay £1,000, and that's the end of the conversation. It's all over. Also, pardon me.
What sort of rules decide whether you can have a Schedule D letter?
Don't know. Don't know. I've only just found this out. This isn't my. If it's anything to do, if it's anything similar to the construction industry, you've got to have a good credit rating, shown that you haven't had any defaults here and defaults there, and you haven't got a criminal record and things like that. And that's probably why it's becoming more and more difficult to get one, because you probably haven't got a credit history. And the credit history you might have just said, well, he's had a student loan, or you haven't, people that have a mortgage, as soon as you borrow money, you've got a credit history. As long as you keep paying that mortgage back regularly, they give you a 3-star or 5-star rating. Your credit is good, because you borrowed, in these days, 250,000, and you borrowed it 3 years ago, and you've made payments every single month for the last 3 years, and you haven't defaulted, and you haven't got any county court judgments against you. The system knows who you are if you've borrowed money. If you've never borrowed money and you haven't got a credit card, you won't get a credit rating, because nobody knows who you are. You could turn around and say, but I haven't got any bad debts. Yes, but at the same time, we still don't know who you are. We don't know if you are who you say you are. And that's probably why you won't get a credit rating. It's probably why you wouldn't get a Schedule D letter. Because with so many people nowadays going into media, you're all of a similar sort of age. The majority of you, if I may be bold, early 20s. People of early 20s don't have a credit rating. So, as I say, it's difficult to get the Schedule D letter, but it's easy for you to become a limited company than to get a Schedule D letter, probably. Yeah. 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 Exactly. I mean, everybody's got a national insurance number, or can get a national insurance number, but it doesn't do you any good. As you say, if they're not on the electoral roll, then people don't have a clue who you are, But that's something and it's very difficult to get this sort of information, because although production companies openly admit that they would rather pay a limited company, they'll never put it in black and white, because it's not quite the way that HMRC wanted it. I don't believe. But anyway, the other thing is that with limited companies, you've got a lot more obligations to fulfil. Record keeping, yeah, you're doing that as self-employed. But with the record keeping, you have to then keep records of, you know, your insurance documents that cover you, that cover the company, that cover your employees. What is it? I've lost the word. Hang on a minute. It's the employer's liability. You get a certificate when you have an employer's liability insurance, which you have to have as an employer. You have to keep that certificate for 40 years. So whether or not you've still got that limited company in 40 years' time, you as the ex-director of that company, say you've closed it down or you've moved on to a different company, you have to have a copy of that insurance document. And the main reason for that, 40 years is a hell of a long time. The main reason for that is that because there are certain things that might happen in your industry, it's not so much nowadays because it's mostly digital, but in days gone by, when you were using chemicals to process photographs and that sort of thing, whatever those chemicals were, they might be harmful. Well, we don't think they're harmful 40 years ago. I mean, nobody's got any problems with it. But in 40 years' time, you get some guy that comes up and says, look, all the skin's falling off my hands. And they can prove it was the chemicals that was used in photography in 1978 or something, then they'll sue you. But if you've got that insurance document, you can then go to the insurance company and say, look, you were my employer's liability insurance people, and therefore I'm being claimed on, so you go and sort it out. And then you have no liability then. But if you haven't got that document, sounds like a long time, it is a long time. If you haven't got that document, you'll be the one that's taken to court. See, that's all the other things you need to think about. Also, with directors, the directors of your limited company, you would be employees, so would need to run a payroll each time you pay yourself, even though you're the only person that works there. You are an employee of that company. Directors can take part of the company profits as dividends, which are not taxed at the same rate as income tax. And dividends do not attract national insurance contributions. So you're sitting there now thinking, oh great, we'll take all of our profits as a dividend. Okay, well where's the tax man going to get his money from to help us to keep running the country? If you take all your income as dividends, you won't, as I say, you won't pay as much income tax and you won't pay any national insurance. But the tax man's wise to this. Well, how are you living on a month-by-month basis then if you're taking all of your dividends, all of your company's profits as a dividend? You're not on a salary. You're an employee of the company. You know, you should be taking some sort of salary. So there's all this sort of stuff to think about. The other thing is that if you took money out of your company every month, and at the end of the year, it actually worked out that you'd taken out more money than the profit that your company had actually made, HMRC then say, well, in that case, you've had a loan from your company. And we'll have to charge you tax on the interest that you would have paid had you borrowed that money elsewhere. You see how much more complicated it gets? Because you're borrowing money from your own company, which will all say, yeah, fine, okay, it's my company, I can do what I like. Yeah, but you're going to have to pay tax on it. You're taking the benefits, the tax man will tax you. With self-employment, all you need to do each year is to submit your self-assessment tax return, as we saw back there, which can be done in about 2 hours if you keep your records up to date. With limited companies, you have to submit a return. You've still got to have your self-assessment tax return. You still need to know what your personal income is. You've got to send an annual company report to Companies House, which is just information on the companies, who the directors are, where they live, what colour shoes they prefer, you know, all the rubbish that they want to know. You've also got to send an annual financial report to Companies House, which is a bit like profit and loss, which is again a bit like what you send an annual financial report to HMRC. But these 3 items, it's all basically the same information, but in different formats. And they all have different dates that they've got to be in by. And you've got reports to send in about the directors and the employees. Now, the worst one here for directors and employees, the tax year ends on the 5th of April. You have to get a report in by the 19th of June, I think it is, to do with any benefits that your employees have had, any benefits that you've had, who's got a company car, who's on medical insurance that you pay, and all this sort of thing. There's a lot more involved to having a limited company. if you're a limited company on your own, it isn't, yes, you've still got to do all that, but it isn't really that scary. But once you start getting employees, you'll probably end up needing to employ somebody to look after the employees. You know, and it escalates like that. If you decided to become a limited company, you would almost definitely need help from an accountancy practice, a company where they're full of accountants and their assistants. This is because the rules and the regulations and the dates, they change probably every year, that HMRC want you to do. I don't get involved in that because I'm not a firm of accountants. I'm freelance. My aim is to do tax returns, etc., and help very small businesses out, self-employed, etc. You know, as I say, with limited companies, it just takes too much time. And I'd rather have the variety of different types of people doing their tax returns. Again, this isn't my forte, but I know about it. It's liability insurance. Whether you're self-employed or whether you're a limited company, you will need at least 3 of those. If you're a limited company, you probably need all 5 of them. Professional indemnity, that's in case somebody just decides for the hell of it to sue you. Public liability, if you damage somebody's property or person, or if they visit your premises and fall over, like if you're working for the BBC and you trip over one of their cables and headbutt one of their screens and it's £1,000 for the screen and you've destroyed it, they'll probably sue you for that, because you don't work for the BBC, so they can't claim it under their insurance because you're the one that's damaged it. Product liability, it may or may not be relevant. You're responsible for the quality of any products and any problems that occur with those products once they're sold. Well, you're probably not selling products, you're probably selling services. So it's probably not necessary. Employer's liability, as I said, it covers your staff, accidents at work, or, for example, exposure to hazardous substances. That's where the 40-year rule comes in. Directors and officers liability, as I say, for a limited company, I don't know if you remember, probably about 4 years ago now, there was a big crash on the M5 at Taunton on bonfire night, and lots of smoke apparently, and mist got mixed up together and started drifting across the motorway. I don't know, 60 people died or something like that. And the directors of Taunton Rugby Club were taken to court to be sued because it was deemed to be their fault that the smoke from the firework display had gone over the motorway. It cost, it's all finished now, it cost £3 million, I believe, that court case. But the directors of Taunton Rugby Club had directors and officers liability. They didn't pay a penny. The insurance paid out for their defence. And it was a long case. Let's face it, you know, if 60 or 70 people die, there's going to be trouble.
Which of those, in that specific case, which of those 5 things there?
How do you mean, which?
That paid out?
This one here. Directors and officers liability. Because the directors, in the case of Taunton Rugby Club, were responsible for everything that happened on their premises 24 hours a day, whether they were there or not. If anything happened on there, they were responsible. It's their property. They agreed to the firework display. You know, it was terrible. I mean, but as I say, you know, that sort of insurance probably costs, well, a company I used to work for, I think we paid something like, well, you pay about £300 or £400 a year per director, something like that. So if there were 4 directors and or officers of the company, it's probably about £2,000 a year, but look at the money they saved. And that was well worth that investment. It's like all insurance. You take out car insurance, you think, in fact, I'm not going to have an accident, but you have to have car insurance. And you might drive for 25 years and not have an accident. You think, oh, I paid that premium for 25 years. It's cost me a lot of money and I've never needed it. But as soon as you decide, I'll be all right, I won't worry about that, you'll have an accident. You know, and that's what insurance is all about. It's there as an insurance. It's in case something happens. And that basically is it.